wisdom, guidance, and building a better future for your life. Our featured topic is financial wellness. Shout out to a random subscriber, Opposing Force. Thank you for watching and enjoy the show.
Is that improvement really going to help you sell that home in the future? Because Americans have a tendency to move every 5 to 10 years.
Right.
So you want to make sure that even if you think it's your forever home at this particular juncture, is it really going to get you back the value that you're putting into it? You have to be very careful about your cash flow. And with the world the way that it is today, it's very easy to, well, I have to have this, I have to have that, I have to keep up with the Joneses. And the truth is, no, you don't. Get the things that you need to ultimately survive. And when you're in a position where you're out of that debt, those extra things that you've always wanted, well, go get them.
Welcome to New Beginnings with Keith. I'm your host, Keith Kittler, and today we have a special guest. His name is Chris Daub. He is from Revolution Mortgage, and Chris is nominated with the Susquehanna Style Best of Lancaster 2022. He was selected Best of Lancaster Mortgage Services category. Chris, thank you so much for being here and welcome. I hope that we can provide some value.
I'm hoping so too. Thanks for having me on.
Why do people want to talk to someone like you?
One of the big reasons why someone would want to talk with me would be because I'm a mortgage loan officer. And nobody really likes talking with a mortgage loan officer, but I am essentially the last line of defense slash gatekeeper between somebody trying to buy a house.
Okay.
So, in other words, in most cases, most home buyers, when they think about buying a home, they don't think of the mortgage lender first as they should. They think of the real estate agent because the real estate agent has the fun job of showing them the home, the motivation, the dream, where that real estate agent or realtor is going to ask them, are they pre-approved by a lender?
Okay.
And then that's how I typically get introduced into somebody's life.
Now, under most cases, someone doesn't have the money, the total capital. They might have a down payment, they might have some, but they might not have everything, at which point that's where you would come in. Let's roll back to the point where you got yourself so that you are able to be a mortgage lender.
So the biggest event that happened in my life was actually purchasing my first home. At the time, I was a bank teller for a very local bank to the area that I'm from. And I've always been passionate about money matters in themselves. And so when I was going through the process, it was very interesting to me to learn about as much as I possibly could from that particular loan officer to the point that I actually got interviewed into that job, or for that job, I should say, back in 2009. Unfortunately, it wasn't in the cards at the time, and secretly I was not happy. But later in life, after working various banking and retail management jobs, it was my profile was actually discovered on LinkedIn by a mortgage branch manager who felt that if you were a retail manager working 70 hours a week, if you were able to put that same 70 hours into your mortgage business per week, that there's no limit to where you could go and you could be highly successful.
Now, at this point, were you rather well out of debt or were you like heavy into debt? what led you up to that point, and did your family have the education? I mean, you don't have to answer that question, but did your family have the education to get themselves out of debt? I know that many people do not in America.
When I entered into the mortgage industry, I was married for the second time. And by then, just through being divorced once before and store management jobs only paying 40-ish thousand a year, I was in a really tough spot and I had credit card debt in excess of $10,000 at the time. And when I received the opportunity to get into the mortgage field, it was actually in the middle of getting interviewed for another store manager job that would have paid me 45,000 a year compared to the under 40 that I was making at the time. And I had to make a big decision for myself. Do I either take the job in the field that I know is going to pay more, but isn't truly my passion? Or do I take a bet on myself and see where the mortgage thing goes? And at that time, I decided, hey, I'm going to give this mortgage thing a shot and see what happens and see what I can do. But yeah, I was like every other American out there with heavy debt and seemingly no way out.
Okay. So debt is definitely something that America has decided to attach to their life probably since the days of Kmart and layaway and the invention of the credit card. How does someone typically get into debt? And then what are great ways to get out of debt?
So I think people get into debt either one of two ways. Either having the I got to have it now mentality of, you know, got to have it, don't got the money. Hey, got this Best Buy card, 24 months, no interest financing. Let's make it happen.
Microwave society.
So that's one way. And the other way is more incidental, trying to establish credit, trying to put themselves in a better spot. Maybe they open up a secured card, or maybe they don't have good debt and they're trying to find ways to establish debt. And then they get a card that was specially marketed to them by a company that goes after lower credit scores. And that particular credit card has a high interest rate. And maybe that person's not educated and is unaware of what that impact is. And then all of a sudden they're making minimum payments on a 27.99% APR credit card. And maybe they don't have enough money to pay it off right away and they run into debt that way.
What would be considered good debt versus bad debt?
This is a great question. Anything that would be good debt would be tied to anything that, in my eyes, would be an appreciating asset like real estate. Generally speaking, over time, real estate has a tendency to appreciate in value. Past few years has especially been true in that case, as we saw record growth in home values in 2021, about 15 to 18%. And then we saw 9% growth in 2022 in regards to real estate assets. So if you have a debt that's attached to an appreciating asset, at some point that becomes very favorable for you. And I don't feel, in my view, as a mortgage lender, would be as a bad debt. Now, your bad debts are tied to depreciating assets, such as a vehicle, such as an installment loan. I think student loans are in a very special category. It's the one thing that, while it's tied to debt, you can't take it away. It's not like the colleges can go into your brain and take out the stuff that you learned, right?
Right.
So I consider that to be in a little bit of a special category. While it's not necessarily good debt because it's not tied to an appreciating asset, but if you're able to advance your career with it, if you're able to increase your pay because of it, then I think in some kind of way it can be considered a good debt.
Okay.
But at the same time, there are programs that colleges offer where there's not really much of a job market for. So I think a lot of the student loan piece really boils down to doing your research prior to deciding to go into that major, which I know is tough because when you graduate high school, you're 18 years old and
Everything looks shiny.
everything looks great and you have a bright future ahead of you. At least that's what everybody tells you, right? So I think that's just one of those things that, you've got to be really careful about what degree that you pursue and making sure that you'll have a job that will help you pay for that education, or otherwise you're going to run into a potential big problem with the student loans, especially after the 6-month deferment period where you got to start paying them back.
Right. I know that one thing that I would consider in that same realm is something that's attached to my house. So, like, if I got a loan for my air conditioning system, it is attached to my house, which is then an asset. And I think you're kind of saying the same thing with education because you are then the asset. So it's tied to you. And
Yes.
that's how I view it. But education makes perfect sense. And I support that um, as long as it's done smartly.
And conversely, to expand on that, you had mentioned HVAC as a potential positive debt. And I think that you have to treat improvements to the home very similar to college debt in the sense of doing your research, working with a real estate agent who is an expert in the field and knows what improvements are going to get the biggest bang for your buck, right? And is that improvement really going to help you sell that home in the future? Because Americans have a tendency to move every 5 to 10 years.
Right.
So you want to make sure that even if you think it's your forever home at this particular juncture, is it really going to get you back the value that you're putting into it?
Example, solar panels could help you or hurt you.
Exactly.
It just depends on many factors.
Agreed.
Okay. Now, I know that one thing my dad told me, as far as I can remember growing up, if you don't have the money in your bank account, do not spend it. So for me, if I couldn't write a check for it, if I couldn't go to the bank and literally take money out and pay for my thing, I couldn't have it. I mean, that's what I felt, and that was the ingrained thought process in my head, which in the end, I wanted to get a an apartment, but because I had zero credit, I then needed to have a cosigner and I needed to have someone else be there for me. And for me, it's like, but I have money. I have literally the money in my hand. Just take it. And because I had no credit, I had no apartment until I had a cosigner. And it didn't really bite me in the butt. However, I really wish I understood that because if I did, I might have done something like found a credit card, only bought gasoline on it, only bought a small amount of food on it every week or two or three, paid it off the moment that I got the bill in the mail, and I would then, in theory, I mean, maybe not in practice, but never get any interest, and then I would have that constant reoccurring payment, which would only look good for my credit history. Looking back, that's what I would have done.
Yeah, absolutely. And that's in fact what I actually encourage clients to do is exactly what you mentioned is get a small credit card. If you have to get a secured card and pony up some upfront money at first, it is what it is. Spend less than 10% of the credit limit once a month. Let it get to the statement and just pay off the statement on time. And
What's the
wash, rinse,
magic
repeat.
bad number? Is that 50%? Is that the magic bad number?
So-
Avoid that wholeheartedly?
Sure. So to optimize that portion of the credit score, which is actually worth 30% of the credit score, you want to stay under 10%. Now, the good versus bad line is really at 30%. So once you get over 30%, that's when things start to get a little hairy in regards to credit score. But if you're looking to maximize your potential, you want it to be anywhere between 1 and 9%. So in other words, more than zero, less than 10%.
Hey, so real quick, I know that Chris has some really good stuff, but I just wanted to say thank you for sticking around. And if you really do enjoy this information, then go ahead and click the subscribe button and select the bell notification. This way you get any updates whenever we put out something new. You'll absolutely be notified. And while you're at it, if you could, go ahead and put the word banking into the comments. Let's get back to it. What things have you noticed from other people that made you decide that being financially stable or being debt free is where you want it to be? Was there someone who hit rock bottom? Again, names aren't important. Was there someone who hit rock bottom, or was there someone who found the top that you said, that's what I'm pushing for, that's what I'm going to make happen?
Yeah, I think growing up, without getting into too much detail, I had the luxury of seeing two different families manage their money in different ways. And it literally is good versus bad. Uh, in case the one family always paid their bills on time, made it a point to make sure that they put themselves in the best position possible given what situations they had in front of them, always made smart money decisions. The first few loans that I had, I was very lucky to have co-signed. So that allowed me to establish an excellent credit history prior to purchasing my first home in 2009. But then I got to see the other side of the coin at that same time of going to the mall every week and putting it on the credit card, which then ultimately meant that they had a negative credit event in their life that impacted their credit score for 10 years. And being able to see both sides of that spectrum growing up, ironically, is also part of the reason why I ended up not getting a college degree. Because nobody had the availability to help me sign for FAFSA loans. And I'm very lucky and very fortunate in hindsight, which is always 2020, to not have them and to be in a field where I do have unlimited income earning potential. And if I could potentially make six figures every year, depending on how hard I worked, right?
Absolutely.
And having that capability without having to worry about those college loans that we were talking about earlier, it's nice to have that freedom and flexibility. But my initial ambition coming out of high school, I wanted to become a music education major and wanted to be able to teach high school band. That was the biggest thing that I wanted to do. And I never got the opportunity because of some of the setbacks that I had in my early 20s and in late teens. But
Makes sense.
as I said, hindsight's 2020. Fair to say, it all worked out. And while I don't have a teaching degree in my field and what I do now, I essentially get to educate people on financial literacy and financial education.
Very nice.
So, I think in the grand scheme of things, everything played out to the best of what it could have been. And I am forever grateful for the opportunities that I've received to be able to help people have a better financial life.
I like it. So I think what you said is the mindset of being financially capable, financially stable comes paramount with being educated with finances. Like, I feel that I was mostly left in the dark with my parents' finances. It's not that I feel I needed to know any of the details, but I didn't have the education of how they did things. I learned from high school how to write checks in a checkbook. I didn't have the information of what credit was or how a credit score would positively or negatively affect me and things that I could do to make it positively affect me. I feel that I was financially, I'm going to say, numb. Like I had no idea what to expect.
It's tough. And growing up, I didn't necessarily have all the details either, but definitely picked up on a couple of things along the way. And, I remember in ninth grade having a personal finance class. And I think that's really started my passion because I was super interested in learning about credit cards and loans and other financial vehicles. And to be able to have a class like that not every school district offers, I think it was really nice to be able to have a little bit of an idea of what I was walking into my early 20s.
And that walked you right into the bank as a teller.
Absolutely, it did.
Very nice. So, what should be the first thing that someone does to help their finances? Like a budget, a plan, an education? Like what is the first thing that someone should consider? Should they pick up a book? Should they speak to someone who knows wiser? Should they just go to a bank and talk to someone?
So, my recommendation would be to find a financial advisor who focuses on budgeting on top of all the other services that they offer. And there's different types of financial advisors out there. There are some that focus on investments, there are some that focus on insurance, there are some that focus on Main Street America. And I highly recommend somebody who's budget focused.
Okay, makes sense. Now, I think I've heard from you snowball process. I'm not sure what I heard, but what you said made so much sense, and I would like for you to repeat the idea and elaborate it on if you can.
Sure. So there's the snowball method, and then its cousin, the avalanche method. I'm going to focus on snowball first because that's the easier one to explain. So essentially, if you have debts, what you want to do is you want to list all of the debts that you have in the order of balance, where the smallest balance is up on top, the largest balance is all the way down on the bottom, and you write down those balances and what the minimum payments are for all those balances. Then you need to determine how much extra you're going to put, even if it's $1, towards your debt. Then any of the extra funds that you have, you throw it to that very first debt that has the lowest balance.
Only the first one.
Only
Not
the first one.
what's the risk of putting it to multiples? Very slower snowball effect?
So if you put it to multiples, what happens is you lose the motivation factor because all the money, while you're well intentioned by putting it in different places, you lose the focus of why you're doing it in the first place because after a few months, you're going to feel like you're getting nowhere. So you want to throw the money to that very first debt that has the lowest balance. Then, when you pay off the lowest balance, what you want to do is you want to take the amount that you had been paying towards that first debt, and then you want to throw it to now the next account that has the lowest balance. Acting like that debt that you just paid off, acting like you never paid it off in the first place. And eventually, what happens is as the payments get bigger and bigger, as you start to continue to pay off stuff, you essentially roll into this snowball. and it helps you get out of debt faster. Now, the avalanche method is the same thing as the snowball method, except instead of focusing on what the lowest balance is, you're actually focusing on what the highest interest rate is. While it makes more financial sense for you to go avalanche versus snowball, if you actually need the motivation and you feel like that you're getting somewhere, I would actually recommend that you go snowball over avalanche. If you are a long-term person and you can understand that maybe you're not going to see the results right away, but you know it's going to work, then I would recommend the avalanche. So that way you save more money versus the snowball. But the majority of Americans, I would recommend snowball because you have to feel like you're getting somewhere and that you're getting your headway.
Risk versus reward, you still feel the reward instead of it being like a continual fruitless effort, and you're like, I still have 100% of the money going out and I feel like I'm getting nowhere, so forget this, I'm not doing it.
What has a tendency to happen is that the highest interest also has a tendency to be the biggest balance. So what happens naturally is that you're trying to really focus on that big balance. And after 5, 6, 12 months, if you don't knock it out, you're going to feel like, why am I even doing this? So the snowball usually works very well. For me personally, I was able to take this method and use it to pay off all of my debt, which at that point I was easily $30,000 in debt in between a car and credit cards. But because of my field and my earning income and my earning potential, there were a few moments where my paycheck was enough to knock out a bigger debt, where most of America doesn't have that luxury of being able to do that. So I was able to use Avalanche to get myself out and save as much money as I possibly could. And then when I got half of my credit card debt knocked out, I was able to take advantage of a balance transfer option where I got 0% interest on a credit card for 18 months for a nominal fee. So I converted it over to that. And then from there, to help reduce the amount of money I was paying towards debt, then I just equaled out the 18 payments and then I had it paid off before 18 months.
Very nice.
So it actually worked out beautiful on my end. But if you're trying this at home, your mileage may vary on how successful you are, but the more dedicated you are, the more committed you are to executing the plan and sticking to it, the more successful you'll be.
How does your role in the banking industry positively influence other people?
I would say that I'm just as much as a part of the economy as your bankers. Housing is the number one most important thing that we can have beyond ourselves. Having a place to live, having a place to be able to live your life, be able to manage your life, being able to help deliver that dream and reality of home ownership, to bring that shelter, that sense of peace, that sense of calm to a family is very important.
Very nice. The one thing that you mentioned to me a long time ago is stick to your plan, and I absolutely love that. So, would you say that the consistency is your momentum?
I would say so. The biggest thing with plans is that you have to stay consistent, because if you don't, you're just going to fall off the tracks. And then it's going to take even more work to get started all over again.
Okay.
Now, there's nothing wrong with changing course and changing your plan, but not having a plan is essentially having a plan to fail. So, my best advice would be stick to the plan, and if things don't work in the way that you want them to, reflect on that plan and make observations on, did you truly follow the plan, or did you not follow that, and if you didn't, then okay, get to what the plan specified.
Right.
Or if you did execute it to its fullest potential and you made observations, then yes, go ahead and assess what went wrong, make adjustments, and follow the new plan that you've established.
I like it. Are there any books that you would recommend? I'm not sure if there's any titles you can recall or authors. I mean, Dale Carnegie might come to mind, at least he does for me. I'm not sure if there's anything that you would recommend for anyone to get themselves out of the funk, the financial funk that they shouldn't be in the first place.
One of the books that I've read is Total Money Makeover by Dave Ramsey. Now, I understand that Dave and how he does his business, and he's got a YouTube channel, and he's well known. Some of his methods can be considered extreme. But if you follow the basic principles of what he's trying to teach you, of don't spend money that you don't have, and if you are into debt for whatever reason, establishing an emergency savings account, and then from there tackling your debt, if you can start executing his baby steps to a certain degree, it will help you put yourself in the right direction. And I think a lot of the people that do listen to Dave Ramsey on a regular basis, I think there's a good amount that they really need to hear that hard advice. And they need to hear about the rice and beans that he talks about, of, you really need to go no frills on your food budget kind of deal. And while I'm not a big proponent of, you got to go rice and beans, I think you have to be very careful about your cash flow. And with the world the way that it is today, it's very easy to, well, I have to have this, I have to have that, I have to keep up with the Joneses. And the truth is, no, you don't. Get the things that you need to ultimately survive. And when you're in a position where you're out of that debt, those extra things that you've always wanted, well, go get them.
I like it.
Everything in moderation.
Now, you said the emergency savings. I think it's pretty obvious to what that is, just in case you don't have the ability to constantly bring that income in or back. How long should you have a savings built up for?
Sure. So, to be pretty clear, if you're in a situation that you have debt, the only savings you should have is the emergency savings. And here's why. So, if you take a look at where interest rates are today for even an online bank, right now, in this environment, January of 23, interest rates for savings accounts can be a little bit over 3%, which sounds amazing. It's been the highest number it's been in quite some time.
303, not like 30.
3.0.
3.0. Okay, wow.
Right, not 3/10.
I was thinking
3,
30, yeah.
3, the whole number. 3.
Yeah.
And that all sounds great and good. However, if you think of credit cards as an investment, high interest credit cards are at, we'll just use the 27.99 that I used earlier. If you have $5,000 in a savings account at 3%, but you owe $5,000 on a credit card that's losing you 27%,
You're still negative.
you're not going to cash flow. So when you're in a situation where you have debt, you need to keep $1,000 in an emergency savings account. So that way, tires go, you got to take your kids to urgent care, or some other expense that you're not expecting pops up. Your first instinct is to go to the emergency savings account and not the credit card to solve the problem. Then, once you spent that money and you're continuing on your plan, you need to spend time replenishing that emergency savings to get back to 1,000. Then you need to be focusing on debt. Once you have the debt paid off, then I recommend having a reserve fund of 3 to 6 months of expenses.
3 to 6 months. All right.
So a long way to get to the answer, but I think having the clarification and distinction is very important to bring out.
Absolutely. Why you needed the emergency fund in the first place. So, Chris, is there something, since I have you on here, is there anything else you wanted to share? Maybe something else of value?
Sure. So for anyone who is looking to buy a home, I have a program that I utilize that helps put a plan in place for anyone who's interested in buying a home. I call it the 3 steps of home ownership. And I give an hour of my time and give advice based off of their situation to be able to figure out what steps do you need to take to buy a house.
Okay, not bad. I mean, I know that your time is valuable, and it's great that you offer those things because I know that it benefits someone. I know that I currently own a home, but had I had that beforehand, it would have been fantastic because it probably would have helped guide me a little bit more, or at least had a better financial standpoint instead of just the grind and hoping for the best. Well, thank you for offering that.
Yeah, absolutely. It's unfortunate that there's a lot of loan officers in our industry that you call them up, and if you're not ready to go, it's a simple, hey, improve your credit, call me back in 6 months. And I believe that service doesn't stop at I can't help you. So this is my way of taking the extra step to be able to help more people put themselves in the position to be able to buy a house.
Very nice. How can the audience reach out to you? I know that it might be a very specific local circumstance, but how can someone reach you?
Sure. So for the mortgage business that I run, I am licensed in 4 states: Pennsylvania, Maryland, Delaware, and good old sunny Florida.
Very nice.
Yes, hopefully someday it'll work out for me too. But you can contact me by giving me a call or texting 717-917-2632. Or you can find me on Facebook, Instagram, LinkedIn, TikTok.
All of the places.
I'm all over the place.
Well, I'm going to make sure that everything that you want to have added will be in the description. This way, someone can contact you and you can hopefully give someone the right outcome, the right answers that they need, and it'll benefit them. And if it benefits you too, great.
I'd be honored.
Sounds good. Well, thank you again, Chris, for being here, and thank you for providing so much value. I'm grateful to be here with you because I know there are many things with financial education that I just did not know. So I'm grateful for that. Also, anyone else who wants to reach out to Chris, please feel free. The information is going to be in the description, and go for it. I mean, an hour of his time is an hour of your time, but at the same time, it needs to be exactly what you need, and education is key. Thank you for watching, and have a great day.